Surjit Arora, Equity Research Analyst at Prabhudas Lilladher is joining us. Surjit, good morning. Good to have you with us here. To what do you attribute this strong performance of Maruti 2? Is it pre-buying because of the 30th June deadline, which got extended, but I mean pretty late?
Yeah, if you look at Maruti, they reported some 34% growth, and if you look at the domestic market, they itself reported some 30% growth there. Now, 3-4 pointers to that. One is, yes, some pre-buying happening due to anticipated excise duty rollback expected by people in the budget. Second was the new launches. I mean, they had launched Celerio 3-4 months back, which is doing 5,000 a month. And one critical point here for Maruti is that the first-time buyers, which also the company mentioned yesterday, have come into the market. Like, for example, if you look at Alto and WagonR, which are the entry-level vehicles for Maruti, this segment has grown more than 40% for this particular fiscal, for the particular month. So if you look at WagonR per se, which normally does 12 to 13,000 a month, this month they have done 17,000 of WagonR. So net, the first-time buyers coming into market, excise duty expectation of rollback in the upcoming budget, plus new launches in face of Celerio, and also some pent-up demand. I mean, we have seen customers postponing their purchases. And in fact, one of the key reasons for Maruti doing well is, again, if you look at the retail sales for this month, they are higher than the wholesale dispatches. The domestic dispatches in wholesale market was 1 lakh units, but retail had more than 1,07,000 in the retail market. So yes, customers are coming into the showrooms. Actually, that is also getting converted into sales. So given the strong portfolio of their products, right from Alto to WagonR, all the way to Swift Desire, and with the pent-up demand and excise duty also playing some part in terms of pre-buying happening, overall volumes seem to be pretty good for Maruti. And according to our interaction with management, they seem to be pretty confident that this year we'll see a very healthy double-digit kind of a volume growth in FY15 for the company.
Right. Yeah, so it's an interesting point that retail sales are for Maruti were higher than the out of the factory gate sales, right? That dealer level.
Yes.
Yeah. For the two-wheelers, it's the opposite problem. I mean, there, especially with companies like Honda, etc., what we've been hearing is that wholesale numbers are much higher than actual retail sales, end sales.
Yes, I mean, if you look at Honda, as you rightly pointed out, I mean, I have been maintaining this point for last 1 year, that Honda is hurting Bajaj more compared to Hero. And in the northern market, which is a strong foothold for Hero, Honda is just increasing the inventory levels with the dealers on the motorcycle side. I mean, compared to 4 weeks of inventory on motorcycles, they have now almost 7 to 8 weeks of inventory on the motorcycle side. So as you pointed out, the inventory build-up or the dispatches to dealers is quite high compared to the retail demand happening on the ground level, specifically for Honda. And currently Hero numbers are not out, but if you look at Bajaj numbers, they have been tad disappointing with 8% kind of degrowth in the domestic motorcycle segment, vis-a-vis 26% growth for Honda. So what Bajaj is doing, it is matching retail sales with wholesale, whereas in case of Honda, the wholesale dispatches are much higher than actual retail which is happening on the ground level.
Yeah. Okay, fair enough. So to play the passenger vehicle growth story, I mean, just to go back, Maruti is best placed according to you, Surjit, right?
Yes. I mean, if you look at Maruti, as I said, 2-3 things happening. One, volume growth will be far ahead of what industry will be in FY15. Plus, they have a couple of new launches scheduled for next 5 to 6 months, including a sedan and a SUV. And also Celerio volumes will come this year compared to last year. So all the 3 models, coupled with the fact that there is a pent-up demand and their network of dealers and sales and services, I believe yes, Maruti is better placed. And once the volume kicks up, then the overall discounting in the market will also come down, which will help them improve their margins a bit. So on volume front, they will be ahead of the industry. Plus on the margin front also, I believe there could be some positive surprises on the EBITDA level from Maruti. So from stock perspective also, we continue to maintain Maruti as our top pick in the frontline auto space.
Okay. And of course, there is that 800cc diesel engine as well, which Maruti has spoken about. I mean, that could really be a big one because Sales of, I think Tata has
Yes.
an entry-level diesel model, Ford has one, but I mean, they're not doing well. Maruti could change that.
Correct. If you look at in the small car segment, the only vehicle which sports a diesel engine is this General Motors Beat, which is a 1000cc engine.
GM.
But to get that diesel engine for 800cc product, definitely it will change the things for the better. But however, it will take some time. It will not happen in next 6 months or so. So we will have to wait and watch. But yes, there has been some demand which is lying idle. Once this 800cc diesel engine comes into a market, and with the kind of network Maruti has, I have no doubt that they will be successful in this kind of a product going forward. So that again will add incremental volumes to their overall sales in FY16.
Yeah. So Bajaj has been hurting, as you said. I mean, all the Discover, they got, some would argue and say they got too many models, right? Discover. The latest one is not done as well as the management had hoped for. Maybe, the Pulsar, which is priced little steeply as demand picks up, will start to do well. But what's your view on Bajaj as a stock, Surjit?
See, we have been maintaining on your channel also that we are more bullish on Hero MotoCorp vis-a-vis Bajaj Auto, and Bajaj Auto will continue to lose market share. Yes, Pulsar segment will see some revival with the economic revival happening, but end of the day, with so many discovers in the market and so much of cannibalization and confusion in the mind of customers, I believe they will have to get their strategy right. So even if they do well in terms of, let's say, domestic volumes, which are now at 150, 160, still they will not be able to generate any positive growth in the domestic market this year. So from that angle, on a comparative basis, I will still be more positive on Hero compared to Bajaj, and as I said, in the overall auto pack, we will be more bullish on Maruti compared to any other stock. So Maruti, maybe within two-wheelers, Hero over Bajaj. That will be our preference.
What about something like a TVS Motor?
We don't have coverage on TVS Motor, so it will be difficult for me. However, on the volume front, they are doing pretty well. I mean, their scooter Jupiter is definitely seeing some traction in terms of consumer demand and all, and that is likely to continue. So from a volume angle, I definitely believe TVS will also continue to surprise. But as I said, we don't have coverage on the stock, so difficult for me to give any target price on that.
I don't know if you've got coverage on Eicher Motor, which is, I mean, the stock has done phenomenally well. Surjit, do you track that one?
No, I don't have coverage, but the story there is more of a two-wheeler story where they are, Royal Enfield is doing pretty well. I mean, despite their production ramp up, still the waiting period for a product is anywhere between 5 to 6 months. So it's more of a story of a standalone business, which is your Royal Enfield. But going forward with CV cycle also reviving in next 6 months, I believe that will also provide some tailwind to Eicher. So though we don't have active coverage, but from a investment point of view, we like that stock, given that both the triggers, one on the two-wheeler side, which will continue to clock, 15-20% kind of volume growth with a EBITDA margin in excess of 20-25%. And on the other hand, which the CV business, which has been on a downturn, now with recovery in the overall CV industry, I believe they will also do well there. So the tailwind will come from CV, and the standalone business will continue to contribute to the free cash of the company. So from a balance sheet angle and from the growth angle, I still believe there is some juice left in Eicher Motors from current levels also. So that is in a very sweet spot at this point of time.
Okay. The budget is on the 10th of July. I don't think there are any, for the auto industry, there are any expectations specific to the sector, right? The excise extension, extension has happened. So, not very much.
Frankly speaking, we were expecting that something will happen on the excise, or it will be, not be increased, and it will continue till next financial year. So already before budget, that announcement has come where extension of excise has been taking place, which itself is a positive for auto industry. So I don't think there will be any big bang announcement on the auto side per se, because already the announcement has happened in terms of extension of excise duty. So nothing much expected from the budget for the auto industry per se.
Got that. Do you track any auto component companies as well, Surjit? auto part companies?
Yeah, we have around 8 auto ancillary companies under coverage, including Bharat Forge, Wapco, and Motherson Sumi also. Within that pack, we like Motherson Sumi, we like Bharat Forge, and we have been bullish on Wapco from 1600 levels, but at now 3400, the stock already is trading at 26 times. So we will not recommend any fresh investment in Wapco. But from a 1 year point of view, still Motherson Sumi could be looked at from an investment point of view. So Motherson will be our top pick in the auto ancillary space, followed by Bharat Forge, and then Wapco for that matter.
Right. So Motherson, Bharat Forge and Wapco. I mean, that's the order of preference.
Yes.
That's what you're saying.
Yes.
Right.
Yes.
Right. Do you track Amtech? Again, something which has done phenomenally well, Surjit?
No, I don't have Amtech under my coverage.
Right. Which are the others that you cover apart from these three? You said you track 8 companies, right?
Yeah, I track Exide, Amaraja Batteries, C8, Apollo Tyres and Balakrishna Industries, apart from Motherson, Wapco and Bharat Forge.
Right. I mean, the entire space, I can safely say, has done phenomenally well, right?
Yes, I mean, if you look at tyres or batteries, there is more of a raw material impact as well as on a demand side. I mean, for tyres, it's more of a rubber coming down, and hence their margins are expanding stupendously, whereas on the battery side it's more of a replacement market and your home inverter market which is doing good. So on one hand, battery makers are still available at 14 to 15 times 1 year forward. On the other hand, tire stocks already have seen some re-rating and now they are trading at some 10 to 12 times 1 year forward. So despite these run up, I still believe next 1 to 2 years auto ancillary companies across segments should still benefit out of the recovery in auto sector. And given their low capacity utilization, I mean, if you look at Bharat Forge, their utilization on capacity front is hardly 60%. The moment you see the higher utilization, you also see margins improving there. So there could be a positive surprise on the earnings front for Bharat Forge also. So majority of the small names in auto ancillary, the utilization, once it improves, they will get some operating leverage and that will lead to huge growth in terms of bottom line for these companies. One of the stock which I would like to recommend is LG Balakrishnan and Brothers. It's mainly into automotive chains for two-wheelers. It's currently trading at some 8 times FY16 earnings with an earnings CAGR of 20%. I believe from a 1 year point of view, it can easily trade at around 1200 levels, which is an upside of around 25% from the current levels. So that is one stock which we are very bullish on. Current market cap is only 600 crores. But in terms of revenue, bottom line potential, it can easily grow at 20% earnings CAGR for next 2 years.
3 months it's gone up 2 times, 6 months I think it's gone up about 3.5 times, and over the last 1 year it's gone up 5 times, right?
Yes, I mean if you look at last 1 year, it has done phenomenally well. But going forward also with now, they are mainly suppliers to two-wheelers. So now with two-wheeler industry also looking up and at least growing at 8 to 10% for this fiscal, I believe these companies which have supplied to two-wheelers and have very good balance sheet with ROE of 20-22%, I still believe there is some steam left in these stocks where you can see 20-25% further upside in 1 year time frame from here on.
Yeah, never look back at what stocks were trading at, right? I mean, you'd never be able to invest.
Absolutely, the kind of market we are in, it's difficult for an analyst to predict how much value it will generate in terms of multiple.
Yeah, so just one quick last question on tires. You'd agree JK Tyre is the cheapest tire stock?
Yeah, definitely it is the cheapest tire stock compared to C8 or Apollo. But then again, if you look at the balance sheet, the kind of capex they are doing and kind of debt they have, I don't foresee that going to levels of, let's say, Apollo or C8 where they are trading. So maybe yes, from a 6 times 1 year forward perspective, it might trade at, let's say, 8 times 1 year forward. But it will not reach at 10 to 12 times which Apollo enjoys, because Apollo, if you look at their return ratios, return on equity and return on capital employed, that is around 18 to 20%, whereas for JK, it's still hovering around 12-13%. So I don't think in terms of balance sheet or in terms of return ratios, JK will trade at a same valuation as that of Apollo at 10 to 12 times. But yes, compared to other stocks, it's still cheaper at 6 times. So it might move to, let's say, 7 to 8 times 1 year forward, which will give you still, a decent 20% kind of upside from current levels.
Surjit, so is the thinking with tire companies, is the thinking is it on the lines that, well, these companies will be treated as FMCG plays, branded FMCG plays, and hence they should deserve 20 times, 25 times P multiples. Is that the thinking?
Frankly, I don't subscribe to that view, because end of the day, last year was a bumper year where your rubber prices were at all-time low. They had gone down by 40%, and these players had an understanding where they did not cut the prices. Ideally, when your inventory levels go up, there is a price cut in the market to pass on the raw material benefit to the consumer. But this time it has been different, where all players have an understanding where they don't take their prices down despite raw material coming down. So FY14 was a bumper year where your margins improved by 400-500 basis points and your cash flow from operations improved substantially. But going forward, everyone is getting into capex mode. So I don't think free cash flow generation will continue forever in tire industry. So given that free cash flow from here on will subside, and you might not see huge free cash flow going forward, and growth also, every stock has, in terms of earnings, have doubled, but I think from here on the growth will also slow down. So in the context of capex cycle and balance sheet not looking that great and earnings growth also being lower, I don't subscribe to the view that further re-rating, huge re-rating is still there. At best, from 7-8 times they might go to 10 times, but I don't subscribe to the view that from 10 times they might go to 20 times. I don't take that into account, given the fact that still it's a commoditized business. It's totally dependent on rubber. And once we see rubber prices going up in next 6 to 8 months, again, sustaining these high margins of 12-13% EBITDA looks pretty difficult to me. So I don't think they will trade at 20 times, which is a very bizarre kind of valuation. 10 to 12 times looks reasonable, because already one needs to remember that these stocks were trading at 4-5 times. So already re-rating, substantial re-rating has happened. So I don't think incrementally a lot of steam is left in tire stocks at this point of time.
Got that. Surjit, thanks very much. Good conversation. Appreciate you dropping by with that perspective. Thank you. Surjit Arora from Prabhudas Lilladher with his thoughts there. 0.75% is where the Nifty is trading up by. How much the Nifty is trading up by? So pretty close to all-time high, 21,214 points on the Sensex. So this is turning out to be a great week for markets. 100 points on Monday, 25 points Tuesday. Today so far you got about 60 odd points or so. This after last week being absolutely flat. I mean, Friday to Friday I think the market was up about 15 odd points or so. Back in 2, more on the other side.
As the new government takes